Welcome to the Commercial Property Podcast. My name is Suzi Carter. I am a chartered surveyor. I've been involved in commercial property in the UK for 30 years and I've done hundreds of commercial property deals. I'm here to be your guide through the commercial property market, whether you're an experienced investor or whether you're literally thinking about dipping your toe in the world of commercial real estate. I will be here talking to you about all kinds of things commercial real estate in the UK, and I've also got some fantastic guest experts who are joining me. So please do subscribe if you'd like to follow, and if you'd like any more help or information on commercial real estate, please do click www.suzicarter.com, which is my website, and you can find out all the ways I can help you. So stay tuned for this week's episode. Welcome back to the Commercial Property Podcast, and today we are talking about something you may have read about in the press, which has now become law, and it's the headline banning of upward-only rent reviews by the government. Now, let me just explain what an upward-only rent review is for those of you that don't know, and I can explain why this is important, because upward-only rent reviews are in commercial leases very often. So sometimes we see upward and downward rent reviews, which means that the rent could go up or down. And there's key review dates in rent reviews. So very rarely that might be annually, but very often that's kind of every 5 years or maybe sometimes every 3 years. But what it means is that commercial leases keep up to date with inflation. So if you've got a long lease, like a 15, 20-year lease, then obviously by the time that lease ends, the starting rent of the lease is going to be way out of date. So the intention of upward-only rent reviews has always been that basically leases keep up with inflation. Now, the kind of slight wrinkle from a tenant's perspective, or a big issue from a tenant's perspective, sometimes can arise where market rents have fallen. Because what a lot of these open market review clauses say is that the rent is upward only. So it can only go up. So if the evidence, that basically you look at comparable evidence, and if the comparable evidence doesn't show that rents have gone up, then it'll be something called a nil increase. So the rent will stay the same. Now, of course, there's a big problem from a tenant's perspective if rents have actually gone down. Because if market rents have gone down, maybe there's been a market drop, or something like COVID happened where we saw a lot of retail rents going down, for example, as a lot of secondary office rents have gone down recently. And what that means is that tenants are tied into these leases where they don't see a reflection of the market. They basically have only that the rent can only go up, not go down. And the government has taken exception to this. Various governments over the last 40 years have tried to look at this, but they've always consulted with the property industry, which is the right and proper thing to do, obviously, because very often government don't understand the nuances of what these clauses mean. So obviously, as I'm explaining it to you now, it seems highly logical that actually there should be more fairness in leases. And that's exactly where the government's coming from. The government's basically saying that, especially for small high street operators, it's really affecting their modus operandi, it's affecting their profitability, and it's going to get our high streets fuller because people are going to be tied into less onerous leases. And of course, simplistically, that might appear to be correct. But there's a lot of nuances with regard to this. So the first thing to say really is that a lot of those small tenants on high streets and other kind of small tenants, they actually have got such short leases now very often, so 2 to 5 years, that they don't even have a rent review in it. So, I think it's pretty misguided for the government to say that all these tenants now have they're all going to be freed from these onerous rent review clauses, because I would say, from experience, nine times out of 10, these tenants don't even have a lease that's long enough to merit a rent review in it. And the reason for that is market forces. So the market does this stuff. The government doesn't need to intervene in this stuff because the market does it. What's happened, especially on the high street and especially where there's lots of empty shops, is that market forces have dictated that the balance of power has been very often in the tenant's favour. And if a small tenant's negotiating and they can go to one of 5 units, say, they're not going to say, oh, I'll get tied into a 20-year lease with 5-yearly only rent reviews. What they're going to be saying is, okay, I want flexibility. I want short leases. I want the ability to break, perhaps. And so that's kind of happened already. So part of me thinks that, and maybe this is the cynic in me, part of me thinks that perhaps the government is trying to reduce rents so that tenants are more able to pay the higher business rates that they're putting forward. But perhaps I'm just being cynical. Anyway, moving on from that. Upward only rent reviews are very important because they affect valuation. So in commercial property, as many of you will know, commercial leases are often more important than the actual building. Obviously, the building attracts a tenant in the first place, but the quality of the lease will affect the valuation a lot more than actually the building will. So long leases, upward only rent reviews, valuers like, because it gives certainty of income going forwards. Now, obviously, there is a potential valuation problem here, is if that rents could go up or down. But don't worry, there are some massive opportunities here that I'm going to talk about shortly. But on the face of it, we might see a differentiation between old leases where there are upward only rent reviews, because this doesn't apply to leases before the 17th of March 2026. Now, they have put a date of the 17th of March 2026 down as the date, even though the legislation probably won't come in until 2027, maybe even 2028. And so there's kind of this retrospective ban. But older leases than that, you can still operate the leases as normal. So don't panic if you've got leases in place where there's upward only rent reviews, because existing leases will still have the ability to operate as normal. And we may see a differentiation between valuation of those kind of leases and newer leases in the short term, especially where solutions haven't been found to overcome this issue, which I'll talk about in a minute. And what usually happens in these cases is that the RICS, the Royal Institution of Chartered Surveyors, they will all get in a dark room together, they consult with the industry, and they will provide a guidance note for valuers, which will basically kind of give them an indication of how perhaps they should now be looking at these kind of new leases. So we'll wait for that to come out. But as importantly, what you need to remember about the commercial property market is that it's, especially UK commercial property, has been a very favourable asset class for sovereign wealth funds, overseas investors, high net worths, pension funds, property companies, of course. And the reason for that is because it is varied. One of the reasons is because, these great lease structures where they're inflation linked, you're not going to see rents go down. And so if you think about it, if you're a sovereign wealth fund or you're a pension fund, that's actually really important because you're guaranteed your rent's not going to go down. Obviously you need to make sure that the tenant covenant's good, so they're not going to fall away, but your rent's not going to go down. And equally, you'll probably see some increases over the kind of medium to long term. And that's really important from a valuation perspective and from an institutional perspective, because, if you're trying to provide income to pensioners, for example, you want to know that you're not going to see a sudden hole in your finances. So the top end of the market has been very much propped up by those kind of investors. And, this is a problem for them because there needs to be a way around this. Otherwise, potentially that money could go anywhere. That money doesn't have to stay in the UK or even come to the UK. That money could go to Portugal or Spain or Germany. And in fact, quite a lot of it is at the moment. It could go to Australia, it could go to America, you name it. That money is pretty footloose. So, they will go where the markets treat them best. And another benefit that investors, especially overseas investors, have seen in the UK is the fact we have a stable government. The government doesn't just introduce these laws without consultation. Now, of course, that's exactly what's happened in this case. So there are some jitters in the market right now because we've got a government who has proven to be unreliable and non-consultative, which is a problem for the industry. And we've got these lease structures that potentially might be affecting value going forwards, and definitely certainty, and there's definitely kind of issues with that. Now, I'm going to talk to you about solutions in a minute and potential solutions in a minute, but investors really like UK commercial leases because there's been predictable income, inflation protection, strong valuations, better lending terms, long-term institutional confidence. And we are at risk, and the market is saying, we're at risk of losing that confidence. And so, we're in a down phase at the moment in the market anyway. And we desperately need some market confidence. And so the government with this has just not given the market anything. And so, this is potentially an issue for the market. Now, of course, there's always opportunities. So hold that thought, and I will kind of come on to that. It's just worth mentioning that because of the what happens on a rent review is that usually there is a process. So there is quite a long rent review clause, which to begin with needs a solicitor to do quite a lot of drafting. They'll have things called assumptions where, things you'll assume on the rent review, which might actually be artificial, and disregards, which again could be quite artificial. And there'll be a process, and if you can't agree, you can apply to the RICS for an arbitrator or an expert, and there'll be, time of the essence. Is it important to serve notices in the right timeframes, or is time not of the essence, which means you can implement the rent review anywhere, any time. So there are these really quite long, detailed clauses which take a solicitor, to draft them. And then when you come to the rent review, there's notices that need to be served. What usually will happen is a rent review surveyor will prepare a report for you. The tenant will have a similar report usually prepared for them. And then there'll be comparables batted backwards and forwards. And if you can't agree, which very often happens, you'll have to go to arbitration or see an expert at the RICS. And sometimes the process can take 18 months, 2 years, maybe longer. And really, it's not a good use of anybody's time. It creates friction and lack of coherence in your tenant-landlord relationship. It's a time lag. It creates uncertainty for valuations. And, it's not a great mechanism, honestly. So what's been happening in the market in recent years, in the last 10, 15 years, is that index-linked rent reviews have come in. So basically what that is linking rent reviews either on an annual basis, compounded, or every 5 years or every 3 years or whatever it might be, to the consumer price index or the retail price index. And there's usually a cap and a collar in that. So it might say link to the consumer price index with a collar, i.e. a minimum increase of 1% and a cap of 5% or whatever. So obviously inflation is 13%, then a tenant's not going to be penalised. Equally, if inflation is 1%, then the landlord's still going to get an increase. So it's actually a great mechanism because you can just look at what the CPI has been or the RPI has been for the last 5 years. You can compound it up or whatever the clause says, and it doesn't you can do it yourself with a bit of checking perhaps, and it's an easy clause. And I would strongly recommend if you can to put those kind of rent reviews in actually, because it saves a lot of costs, a lot of hassle, a lot of drafting. They are great clauses. And I think that potentially those kind of index-linked clauses will be the solution to this particular problem we now face going forwards. So there's where we are at the moment is that you'll read articles about this. If you Google this, there'll be all kinds of solicitors. There'll be surveying firms, RICS commenting, tenant forums. Obviously it's relatively positive for tenants. So, but actually, as I say, a lot of market forces have been creating this for tenants. So I don't think that there's going to be kind of whooping from the streets from tenants. I just don't think, I think this kind of stuff is happening anyway. So remember, this is now retrospective to the 17th of March 2026. So that bid has actually shocked the market. That was introduced in the Lords. And if you're looking for the bill, this is the new devolution bill that came out. So it was kind of snuck into that without the market realising it. So, a bit shady by the government, I would say. So
this episode is brought to you by Bond Finance Limited. your trusted partner for commercial property mortgage solutions. Are you an experienced residential property investor about to diversify into commercial property, looking for funding options? Bond Finance can help. Whether you're planning to expand, refinance, or make a major property investment, Bond Finance provides expert advice with access to a wide range of lenders, from high street to specialist. Book a free discovery session today to explore how we can tailor commercial funding solutions to your unique investment strategy. Visit www.bondfinanceltd.co.uk and take the next step in your commercial finance journey.
It creates a bit of uncertainty now for landlords, lenders, pension funds, valuers, solicitors, investors. And we're kind of in this period where the government's now saying that they might be looking to introduce some secondary legislation on this. And so we're kind of in a wait and see pattern on this. But, this matters a lot in commercial, because with residential, you're looking at bricks and mortar values, but we're looking at commercial valuations in commercial property, and that's the difference. So, it definitely has, it's definitely shocked the market, and I think this is where the opportunities start to come in. So let's focus all our attention now on the opportunities, because whenever I read headlines like this, whenever there's news like this, I put a different pair of glasses on than perhaps a lot of the market, and I start to look at opportunities. So, as everybody's kind of reeling and trying to work out, kind of what the impact's going to be, what we want to do is we want to look at where there's going to be massive opportunities for us as investors. And I genuinely think there will be. So at the moment, index linking stepped rents, which is basically where you might agree a rent with a tenant up front, where year one they pay one rent, year two it goes up a bit, year three it goes up a bit or whatever. They're not affected at the moment. So we'll see whether that continues. But obviously in the short term, that is a solution to this by introducing step rents, perhaps shorter leases. I mean, obviously there's a pro and a con with that in terms of valuation. Usually valuers like to see longer leases. But we might naturally see the market moving more to shorter leases anyway, so that landlords can review rents, more frequently, perhaps. So we'll have to see that. We might see tenants trying to introduce more break clauses with rent review clauses, so that if it is index linked and they don't like it, they can break the lease. Obviously, they're to be avoided from a valuation perspective for sure. So there's lots of different ways of getting around this. And of course, this isn't avoidance. This is just practically trying to maximize our investments. But the main opportunity, I think, is that, we're in a market where there is uncertainty at the moment, and I've been talking about the window of opportunity for quite some time. So this is just, a widening of the window, basically. That window is actually opening a bit more. And so, what's happened is we've been in this window of opportunity. Buyers have been, realistic about pricing and seen that pricing has dropped. Valuations have dropped, lending has dropped, rates have gone up. Of course, bond yields have gone up. Of course, values have gone down, but vendors and agents haven't got the memo yet. And so what we see in markets is, in the cycle, we see basically a time when buyers want to buy at less than vendors want to sell for. And there's this gap. And sentiment needs to change from a vendor perspective and from an agent perspective to close that gap. And we haven't really seen anything yet. Now, they'll see there's loads of stuff that could happen in the world right now that could do that. We've had the Bank of England deputy governor saying that she thinks that AI stocks are going to crash, which is quite unprecedented. We've got, the inflation going up, the unlikely event of interest rates going down anytime soon, unless the Bank of England's feeling particularly ballsy. We've got bond yields now over 5% I'm talking as of kind of the early May 2026. So, we've got everything's lining up to basically for prices to fall a bit further. But vendors haven't got the memo yet and agents haven't got the memo yet. So you'll still see that asking prices are really high. And, perhaps this is one more step in terms of changing sentiment amongst agents and vendors. And obviously, if you're buying, that's a really good thing. If you're selling, not so good. So if you're an owner and you want to sell, I would suggest you get on with it and look for some speed and certainty, like in auctions, for example. If you're a buyer, then you just want to make sure that you're putting offers out where you've got sensitivities on market movement. You've got properties where you can force value through, and ignore the asking price and work out what actually you can pay in order to make money from that particular asset. So potentially we've got a great opportunity gearing up here. While the market falters, we can pile in and take advantage of these opportunities. But let's talk about some of the solutions to this. Now, I'm going to caveat this next section to basically say that there is, there is a lot of work that needs to be done on this. I think that everyone's still digesting. We are expecting some secondary legislation as well. So some of this advice may well change. So this advice is good as of early May 2026, but obviously, this will change. And you must check with your solicitors in terms of what you're doing as well to make sure that everything is compliant. That is really, really important. So number one is index linked, like I was just saying, and potential solution to the upward and downward nature. At the moment, index linked isn't affected, but if secondary legislation comes in that says that index linked rents are, then potentially you could have negative caps and collars, which might mean that you have a cap of a collar of -3% and a cap of 5%. Now, of course, if inflation is going up, that's relatively, a dead cert for a landlord to get an increase. So, inflation figures are actually going to be really, really important going forward. So that is potentially a solution. What we don't know is how valuers are going to view that. So we need to wait for advice notes to come out just to check that. And if you are going to put that in a lease, I would strongly suggest that you get a valuation done on that assumption. You put a special assumption in your valuation instruction that basically asks the valuer to value it on that basis. So, some of these different solutions, we want to get them valued to make sure it's not going to hit our value. So the benefits of the index link, like I said, is that you don't have to go through all the kind of furore of a rent review clause and appointing experts. It's done quickly. It's greater transparency for both parties, and lenders really like it as well. So at the moment, you can still put index linked in. You can put step rents in. And so that's number two, is step rents, where your rent from the outset, the tenant knows what their rent's going to be maybe for the next 5 years. It creates certainty, again, simplicity, it avoids disputes, and it gives valuation certainty and lender certainty as well. So those two, definitely. In Europe, commonly there are fixed increases, because Europe has got this, very often got this lack of flexibility in nation states. So, basically leases say there's a day one rental, then the rent goes up by 2% in year one, 2% in year three, 2.5%, or whatever it might be. Those uplifts might be compounded. They might just be kind of increases. But whatever happens, the rent will go up. So obviously that can be a good thing. And again, at the moment, that seems to be permitted. Of course, you must check this out with your solicitor. Number four is kind of turnover rents or hybrid rents. So when I was working in the shopping centre world, we used to quite often offer these where a tenant might pay a base rent with a percentage of their turnover as a top up. Now, obviously, that's wrought with issues in terms of getting proper turnover figures from tenants, and things that you might not think of, like, are they accounting for online returns in a store? Because sometimes in shopping centres, we used to have negative daily turnover figures because there was more returns than there were sales. So, that could be a problem for turnover figures. Or you just have a pure turnover rent. Now, that creates quite a lot of uncertainty from a valuation perspective. So unless you've got lots of tenants and these can kind of be, part of it and that's your strategy, or you've got some certainty of turnover from the tenants, then, from a valuation perspective, that can be that can be an issue. But on the plus side, it can allow the landlord to participate in the upside in a growth sector of tenant sales, whether that's turnover on a logistics unit or it's more often used in retail actually. Number 5 is shorter leases. So Landlords might shorten leases so that they get more regular rent reviews by nature of the fact that that lease is ending quicker. They can renegotiate more quickly, use lease extensions strategically, and reset rent through negotiation rather than fixed reviews. So that may well happen. But obviously, every time you shorten a lease, that creates less valuation certainty, and therefore you might see your yield or your multiplier affected by doing that. And number 6 is potentially higher initial rents. If landlords lose future certainty, they might just agree higher rents to begin with. Now, obviously, the market forces will determine whether you can do that. If the supply and demand is in your favour, then that is definitely a way of doing it. And actually, that is absolutely counterintuitive to how tenants might benefit from this legislation. And then obviously, I think a constant right across these is more aggressive asset management. So if you're not looking how you can force value through your properties, through subdivision, restructuring, title splitting, letting vacant space, bringing additional income in like EV charging or advertising hoardings, mezzanine floors, ancillary income, whatever it might be, then you're definitely missing a trick, because you're forcing value through. And I would say that is a constant across all these strategies. You want to maybe making sure that you're doing that in your properties, not just sitting on income. And there is definitely a greater importance of covenant strength, because you want to make sure that you've got a great tenant where they're doing great sales, and you want to make sure you're selecting sectors where there is going to be growth anyway. So this is why I talk about niching a lot, because if you niche your strategies well and supply and demand is in your favor, i.e. there's not that many properties of a similar nature to yours, and there's lots of tenant demand, you're going to get rental growth anyway. There's going to be tenants falling over themselves to take that property. What you don't want to do is buy properties where there isn't much tenant demand, and therefore you're scrabbling around, you're having to negotiate with tenants, that the negotiating ability is on the tenant side rather than on the landlords. That is a surefire way of falling foul of this legislation. So, if the fundamentals are still the same as they are at the moment, if you buy the right property in the right location with the right tenant, good tenant, then you're going to be able to get good rents, good lease terms, and rental growth moving forward. So that's probably the most important thing today, is making sure that you get the fundamentals right. And that's why when I work with my board members, we start with the end in mind. We work out where they want to get to, then we work out what niche they want to invest in, what locations they want to invest in, and then they go out and invest. There's human nature to rush out and do deals, but just pausing on your niche is so important. And sometimes looking at deals can be the best way of actually determining that niche. But it's really important that you niche your strategies to get that rental growth. So, there are definitely opportunities as part of this legislation, and but the potential implications are that the market could create even more opportunities, more buying opportunities, and obviously that's great. We do need to look at what the valuation impact of some of this stuff will be. We do need to look at the top end of the market what the institutional appetite is going to be for commercial property going forwards. And obviously what happens at the top end of the market cascades down. But, if you still buy the right property in the right location, and there's lots of tenant demand, you really can't go wrong with your commercial properties as long as you structure your lease properly. And as I say, you buy in the right location, and you do great checks on your tenant. You make sure the tenant covenant is correct. In the shorter term, there might be a strengthening of prices for the older style leases with the upward only rent reviews in. We might see a short-term two-tier market as well. But I think that we'll see what the secondary legislation says when it comes out. But, the same rules still apply. Buy properties in a niche where you can get rental growth, and make sure you buy at the right price, and make sure that you can force value through. So when you're looking at investments to buy, if you've got a lease expiring, you are not going to be able to put upward only rent reviews in that. So you're going to need to look at some of these other solutions I've talked about today. So, a lease expiry is an opportunity because you could usually buy properties at a higher yield at a lower price because of it. So you might want to, but you just need to bear in mind this legislation. And, when you get your valuation report done before you buy the property, put a special assumption in that you might have to offer some of these index linked or step rents and see what the effect on valuation is. You need to, for older style leases, you need to understand the rent review wording. Definitely speak to specialist solicitors and model scenarios on price. Focus heavily on areas with high tenant demand. That is super important. Prioritize strong tenant covenants. These have always been the case, by the way. It's just a reiteration of good investment in commercial. Definitely kind of understand how lenders will react. So work with a great broker on this. And so, the opportunities are potential sentiment changes amongst vendors and agents, niching being a great opportunity to buy properties in tight locations, resilient sectors with great tenant quality, good lease lengths, ability to get good lease lengths as well, and great asset management angles. And so, these things are always opportunities. They are definitely problems. I don't agree with this legislation. I'm come out and said it. I don't agree with it because I think the market was operating this way anyway. But you know what? There's no point dwelling on that. We need to find solutions. We need to find the opportunities. And I genuinely believe that there are these opportunities in the market right now. So I will report back as and when this develops, as and when secondary legislation comes. But keep calm and carry on. Don't panic. There are opportunities in everything in the market. So put that different pair of spectacles on and go out and find them. I'll see you next time on the Commercial Property Podcast.